It's Money Monday. And welcome. Aman. Welcome to the party. We're going to be getting started here shortly. Douglas is in the building. Grishar, welcome to the party. If you're joining, we got lots to talk about today. Getting started in about under a minute, almost a minute.
You say all the right things when I'm hurting. You always pick me up when I am down. It's like you have a spark that leaves me burning.
This is not a 2-hour session. So, for those who are waiting, we got 1 minute to get started. We're going to be doing a 5-week option series. All right, so if you're watching the replay, you can skip past the countdown. If you're watching live, we're going to get started in just a minute. Got a lot of stuff to cover, but let me know where you're from. Put your comments in. Let me know where you're checking in from. Always love to know who's watching and from where. Jason Bryan is in the building. Here we go. What's up, everybody? Welcome to Money Mondays. I'm your host, Jason Brown, stock market coach and options trader, and we are kicking off the beginning of a 5-week series. So in this 5-week series, we are going to be breaking down options trading. Okay, so very exciting time. So throughout the 5 weeks, we're going to walk you through options. Today, we're going to be talking about options as a big picture. But before we get into that, whether you're watching live or on the replay, you're going to want to make sure you got a pen, a paper, or at least you want to make sure you subscribe or favorite or bookmark this series, because as we drop different knowledge bombs throughout, you may want to pause, rewind, go back and watch some things or take a screenshot as we break down options. Also, before we get started, like I said, if you're not already subscribed to the channel, we are just pushing 60,885 subscribers. Help us get to 100,000 by hitting that like button and hitting that subscribe button, and turn on the bell notification so you can get notified when we go live and you don't miss any of this great content that we're kicking off. So let's talk about what we're talking about today, okay? And we're going to be breaking down options. So in this 5-week series, actually, let me back up. So the 5-week series, part one, we're talking about options, big picture. You just got a sneak peek of the breakdown of that, but we're going to go back through it. Week 2, which is next week, all right, we're going to be breaking down call options. Then week 3, we're going to be breaking down put options, all right? So first week, big picture. Second week, call options specifically. Third week, we're going to be walking you through put options. Fourth week, a lot of people don't understand what spreads are, but they are combinations when you put 2, 3, or 4 or more options together to create a sophisticated option strategy. So we're also going to be breaking that down. And then week 5, we took what we feel is the top 10 option questions that people either email, leave a comment on our social platforms. And so we took those top 10 questions, and we're going to be breaking down those myths, questions, things that are confusing most people in week 5. So like I said, make sure you subscribe, hit the like button, hit the subscribe button so that you don't miss anything. So we got a lot to get into. So let's go ahead and kick it off. All right. So this was the sneak peek you saw a little bit earlier. Why use options? That's what we're going to be breaking down. Like, why even use options? So everyone's talking about them. Some people love them. Some people hate them. You got some people who say options are risky. We're going to break down what they are and why you and everyone should be potentially using options. There's a concept called ownership, which most people are familiar with. You buy the stock, so you own it. But most people aren't familiar with controlling a stock. So we're going to break down the difference between ownership and controlling. What are options exactly? So not just why you should use them, but what are they? What other areas in life do we use options? Because people think that options only apply to the stock market. But once I break it down, you'll probably notice that you participated in an options transaction before and you just didn't know it. And then most importantly, the 4 components that make up an option. One of the things that confuses most people when it comes to options is they're like, there's all these moving pieces, right? Which one do I buy? How do you know if you buy in, out, at the money, strike price, all this stuff? So what does this stuff mean? How does it work? How do I put these components together to formulate an educated decision of if I should be doing this, and if I should be doing it, which one should I be doing it with? We're going to break down those 4 components, and we're going to walk through an options example. So especially if you are live, we're probably going to ask you, the audience, to give us a specific stock. We'll pull up the stock, we'll look at the price, and then we'll kind of construct a makeshift option example out of it. So if that's all right with you and you're loving it, hit the like, hit the thumbs up button, send me some love. What will I do for you? I'll give you the DJ horn. So there it is. Let's get into this entire options series. All right. So why use options? Well, let's first talk about the stock market and how it works as a whole. Okay. And so when you think about the stock market, there's 3 ways that stocks can move. So stocks can move up, and that is the place that most people are familiar with. You buy something low, you sell it high. So most people try to make their money in that avenue, or that's the only avenue that they're familiar with. Now, the second way that stocks move is sideways. And let me make sure I break down sideways, because not everybody understands sideways. Sideways just simply means, let's just say you buy a stock today for $10, and that stock by the end of the year goes up to $20, but you don't sell it. And then by next year, that stock comes back down to $10. So you bought it at 10 one year. The next year it went up to 20. The next year it came back down to 10. If you just look at it on a pure time frame over 3 years, basically, that you held it, the stock did nothing. It went sideways. You bought it at 10, you came back 2 years later, it's still at $10. Okay. So that's what we mean by a stock can move sideways. And that's very important for you to understand, because while you may not have lost any money, you've lost the time value of money, because maybe money doesn't buy what it used to anymore, a year or 2 years later, or most of the time you're missing out on what's called opportunity cost, which means that money could have been in another stock or another investment that was moving and making money, and yours basically did nothing, right? So there are some ways that you technically still lose money, even though physically the money on paper says you put in 10 and 2 years later is worth 10. But again, opportunity cost as well as the time value of money that you lose. Okay. So a lot of people don't account for that. But the third way that most people don't account for that the stock market can move is down. Okay. And so we all know that it can happen. We're familiar with the big sell-off that happened this year as of this recording with COVID-19. Earlier the year, you had the whole China trade war ending the previous year and then coming into the new year. So you're familiar with that big sell-off. So we are familiar with the market selling off, or that it can crash. You've heard of the .com bust. You've heard of the, real estate bust that happened in 2008. You can go, back to the Great Depression. There's different times where the stock market totally crashes or just sells off for whatever reason. Okay. So those are the three ways that the market can move. Now, it's important that we break that down, because that is going to be the thesis of why you need to have options in your arsenal. One of the things that bugs me about the industry of education and investing in the stock market is more people are trying to promote what's better, right? Trade Forex, trade stock, don't trade stock, trade options, don't trade options, be a day trader. And when it really comes to the market, it's more about having strategies that you can use when the time calls for. It's not a matter of if it's good or if it's bad or not. It's a matter of when the opportunity arises. When a stock is going up, do you have a strategy to maybe get a better return? If the stock is going sideways, do you have a strategy to account for the loss of time value of money? And obviously, if the market is going down, do you have a way to profit from it, or at least protect yourself? And that's what this is all about. It's about having strategies and having choices. Okay. It's kind of like college, right? Some people are like, well, you should or shouldn't go to college, but it doesn't matter what they think. What matters is when you have that piece of paper, whether you use it or not, you have some choices that you could make that you might not have been able to make without that piece of paper, or in this case, without the strategies. All right. So let's break it down from a statistical standpoint. So if the market can only move one of three ways, there's not a fourth way that the market can move. The market can go up, down, and sideways. This is simple mathematics. If you divide the market by the three ways that it can move, it's a 33% probability that it's going to move one of those three ways. There's not a fourth, right? So it can only move up, 33% chance. It can move sideways, 33% chance. It can move down. Those are the only three ways that it can move. I haven't seen a fourth one yet. Okay. So up, down, sideways, 33% chance assigned to all three of those. So if you add them all up, you get 100%. Now, when you look at the strategy that most people have, which is buy and hold, right? So if you only buy and hold, and we just determine that the market can move three ways, You only have one strategy, whether that's buying whole, whether that's buying call options that it goes up. That's still one strategy. You're hoping that the stock market goes up. And if it goes any other way, you're in trouble. Okay. So when you look at it from a percentage standpoint, that means you have a 1 in 3 chance of success because the market will for sure go sideways and it will for sure go down at some point. So if you translate that to a percentage, I'm a percentage guy, that's 33%. So you have a 33% chance of making money out of the 3 ways that the market can move. Does that make sense? If that makes sense, give me some hearts, some likes, some thumbs. Let me see some emojis flying, right? Something like that. I want to see the screen just whoosh. All right. So you got a 1 in 3 chance of making money out of the 3 ways that the market can move. 33% chance. Now let's talk about the percent chance of failure then. So if you got a 33% chance that you can be successful, let's talk about the other side. So we know the market can move sideways. So if we assign 33% there and the market can move down, we assign 33% there. When you put that into a percentage, if you don't have strategies for sideways and down, you have a 66% chance of failure out of the 3 ways that a market can move. So it doesn't take a rocket scientist to know that if you only know how to buy and hold, right? That's a 33% chance. If you don't know how or have any strategies for sideways or down, you're leaving 67% of your opportunity, or say it another way, there's a 67% chance that you will fail at this game. Okay. That's just a fact. And so people say, well, why do most traders lose money, or why do most investors lose money? Well, if you think about it, most people are also not sophisticated enough to know what to do when the market goes sideways or down. Anybody, I shouldn't say anybody, most people that you talk to, your friends, your family, on your job, you say, the market's down, what should we do? Like, I don't even want to look at it. I just hope and pray. Most people default to the 2 emotional things that have nothing to do with the market. Okay. They resort to hope and they resort to prayer. Now, those are good things. If you're trying to get a young lady's phone number, you like, I hope this is her right number. Okay. Prayer is a good thing. If you are a religious person, right? You are praying for better days. You are praying for someone sick to be healed. However, in the stock market, okay, hope and prayer, unfortunately, are not 2 strategies that work. Okay. So you have a 66% chance of failure if you don't have a strategy for the market going sideways or the market going down. All right. So the primary use of options, there's really 2 primary uses for options. Now, the fancy word for the primary use of options is called hedging. Okay. Options are used as a hedge against risk. So the 2 primary ways that you use options, one is for growth. Okay. How can you either safely or aggressively grow your trading or your investment account? Okay. So safely, there's a way that you can use options safely, but you don't necessarily get the high returns when you go to safe route. Or you can aggressively, but you can safely grow it. Or you can aggressively grow it and use options to leverage by controlling stocks, which we'll talk about. Or you can come to the other side and you can use options as a protection. So maybe you have a $1 million portfolio, maybe you have a $50,000 portfolio, maybe you have a $10,000 portfolio, and you want to use options for protection. Okay, we'll talk about protection when we get into put options, which I believe is in week 3 when we talk about put options. But I just want you to know that protection is one of the ways that you can use options. All right. So there's 2 investment concepts that fall underneath the growth category. Okay. There's control and then there's ownership. And most people, again, are familiar with ownership. So what is ownership? Ownership is the idea that you're going to buy a stock. Okay. You're going to buy shares of a company. So let's break this down. When you buy a stock, you basically own one share of stock XYZ. And so you own a small fraction of the company. When I say you own a small fraction, let me give you an example. Amazon, they say or Apple, Amazon, even Tesla now, as is the time of this recording, have a $1 trillion market cap. So when you come in and buy one share of Amazon for $3,000, your $3,000 in the grand scheme of the company being valued at $1 trillion is a small fraction of the company. So that's what I mean by when you buy a stock, your $3,000, because Amazon's trading around $3,000 right now, $3,300. If you buy one share for $3,300 of a $1 trillion company, you own a small fraction, okay? Now, you only make money two ways. We're not going to talk about dividends, but that's one way. But you make money if the stock goes up or if the company pays dividends, okay? But we're primarily just focused on whether the stock goes up, down, or sideways for these illustration purposes, okay? So by buying stock, you are in that camp of I only make money one way. Now, let me say this, because I know someone's gonna, leave a comment or something. Well, long term. Listen, I get it. Long term, the market typically goes up. All right. Big picture, if you hold long enough, the stock market goes up. But there are stocks that if you hold long enough, they never came back to going up. You hold long enough, they still haven't recovered from their big sell-off. Ford is one company that I talk about all the time. It was great in its day, but if you pull up a chart of Ford, it looks like this. It's been going down, 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 down ever since, okay? So we do understand that long-term, the majority of the market or stocks go up. But what happens when they don't and they go sideways? You are left in that camp of only making money if the stock goes one direction, which is up. All right. Now let's talk about control concept, because this concept is foreign to most people, but this is technically what you're doing when you venture into the world of options. You are looking to control stock. Okay. So you own the right. When you think about options, you own the right to own a small fraction of a company. Big difference. I didn't say you bought the stock and you actually own. I said you own the right to own. Okay, so it means you have the option to go buy a stock or a company at a certain price. Okay, when you control the stock, you make money by controlling the stock that somebody else wants to actually buy. And we're going to break down how that works, because you're like, well, how do I make money if I don't actually own anything? You'll find out is sometimes more powerful to be able to control it than it is to own it. And we're going to be breaking that down. And then the third benefit of the control concept, though, is that you can control higher, more expensive, higher quality companies for a fraction of the cost. Okay. So like I said, Amazon, $3,300 stock. Well, you could control a $3,300 stock for $400 or $500. All right. And so which one does majority of the people have? Well, they have $200, $300, $500, or they have $3,300 to buy one share of Amazon. Okay. It just depends, right? Depending on who you're talking to. Maybe you're talking to a multimillionaire, or maybe you're talking to 100,000-aire, and they can buy a couple shares of Amazon. But for the average person, being able to control the Amazon versus own it is going to be more cost effective. Now, don't confuse cost effective with whether it's going to be more risky or not. We still have to analyze how everything works and then determine the best time to use an option. All right. So that is the control concept versus the ownership concept. So what is an option contract? When you wrap it all up, an option gives you the right to do buy, but not the obligation. It gives you the right to buy a stock, but not the obligation to buy a stock. Okay. Or I call it an asset. And the reason I said asset is because not every option strategy has to do with a stock. So we're talking about a stock, but I'm going to show you in an example how there's options in insurance, there's options in buying a house, there's options all around us. And so that's why we use the word asset. So an option contract gives you the right, but not the obligation to buy an asset. Okay. An asset. So let's keep going. So let's break down the 4 components of an option contract. All right. So I call it the 4 C's. Okay. These are the 4 components of an option contract. So let's walk through them. So number 1, you have the right to buy a specific asset. So you have to identify what is my asset. So when we're talking about the stock market, we're talking about stocks. If we're talking about real estate, we're talking about a house. We're talking about a car or a boat. We're talking about that as the asset. Now, I'm trying to explain this as best as I can because I don't want people to get so technical and say, well, a car isn't an asset or a boat depreciates. We're not talking about we're not debating whether a boat or a car appreciates or depreciates or a house appreciates or depreciates, because not all stocks appreciate. But the point is, when we say asset, there's something of value that you want, okay? And that you want to have the right to buy. So you have to identify what is that asset. In our case, we're talking about a stock. Now, number 2, C2, okay, is you have the right to buy the asset at a specific price. So these are the building blocks of an option. So when you think about it, you have the stock, right? That is the asset. That's your C1. Now we're putting another block on top of that. What's your C2? So it's like, I want to buy this stock. Now, what's the second block? For how much? Okay, so now we have C2, which is the price. Now let's talk about C3. C3 is you have the right to buy the asset for a specific amount of time. Okay, so the blocks keep getting built upon. So it's like, I want to buy this stock. Okay, great. At what price? Okay, now that we have a price, for how long do you want to have the ability to do this for? Okay, once we determine C1, C2, and C3, okay, the top three components of an option, you get to C4, and C4 is not explosive dynamite. All right, C4 is the cost for the contract or the cost for the right to buy. All right, so let's just go back and think about this big picture again. You got a stock. You identified the asset that you want to buy. That could be Apple, could be Tesla, could be Google. It could be any of those things. Okay. You got the asset. Now you have to identify at what price am I willing to buy this at? Okay. That's going to be the contract, not the price of the contract, but the execution price that if you have to take control of the asset, that is the price you're agreeing to buy it for. That is the price someone's agreeing to sell it for. Okay, now the third piece, again, no one's just going to leave that open forever. So they're going to say, well, how long do you want to enter into this agreement with me for? 30 days, 6 months, a year? Okay, and then depending on that answer, we go to number 4 and say, well, how much am I willing to pay for that contract? And the other person is saying, how much am I willing to enter into this agreement for as well? Like, what do you have to pay me to be willing to enter into that agreement? And you're saying, well, what's the stock, what's the price, and what's the time frame that I feel comfortable entering into that agreement as well? And we're going to walk through an example here, but I just want to make sure at least that part makes sense. So if that part makes sense, go ahead and put "make sense" in the comments, just so I know that you're following along and that everything makes sense to you so far. All right. And then again, we're going to do an example at the end. I already have a pre-planned example, and then we're going to do a real stock that you guys want to see. I'm going to let you guys pick whatever the real stock is. I know some people already said, can we do Apple? Perhaps. All right. So let's look at this and let's break it down even further. All right. So let's use an example that most people are familiar with, which is a house. Okay. And I'm seeing all the make sense come through. So awesome. So let's look at the example that most people are familiar with, which is a house. All right. So if you've ever bought a house before, I'm going to break it to you. You were most likely involved in an options contract. Okay. So let's dive deeper into this. Okay. So you got this house, which is the asset. Okay. And with every house, or same thing with every stock, you have a home owner or a stock owner. Okay. And so this homeowner owns this house and says, hey, I'm willing to sell my house for $100,000. So you got the price tag. So you can start to see the components starting to come together, right? You got your C1, which is what? The asset, house. You got your C2, which is the price of the house that they're willing to sell it for. Okay. And now we have what we call the other party, or the C3, which is the home buyer. And how long does he need to make a decision to buy that house? Okay. So typically in this example, we're going to say 30 days. However, in the stock market, there's nothing typical. You can enter these agreements for a week. You can enter these agreements for a month. You can enter these agreements for 6 months, up to 2 years. Okay. And so there is no typical. All there is time frames, and you're looking to understand if this is a reasonable price to control it at for a reasonable amount of time, and how much is that going to cost you. Okay. So in this example, homeowner owns a house, $100,000 wants to sell it for. You got the home buyer willing to buy it for $100,000 within 30 days. Okay. Now, what brings these two people together in this transaction, because right now, all we had is someone saying, hey, I got something I want to sell, which is a house. We got someone over here saying, I'm thinking about getting into a house. Okay. And once they like each other's assets and time frame, what's going to bring them together and make a deal is the deposit. Okay. Or in the stock market terms, you actually putting money down and buying the option. So in this example, the homeowner is saying, I'm willing to enter in this agreement with you, but you're going to have to leave me $1,000 deposit. Okay. So that, you ever heard, in gambling, they say money on the wood makes the bet good, right? It's just like, put the money down, put it on the table, right? And like, okay, we can enter into this contract. Other than that, all you have is just people talking. Okay. That's what creates a market, by the way. One person has something that they want to sell. The other person has something that they think they want to buy. And it's not until the terms, conditions, and prices meet that we have an exchange. We have a deal. We have a transaction. We have the market. All right. So let's continue. So if we revisit our 4 components, the C1, you got the right to buy a specific asset, the house. You got the right to buy a specific asset at a specific price, 100,000. You have the right to buy the asset for a specific amount of time, 30 days. And then the cost of the contract is the $1,000 deposit. So just visually, that is how it looks, right? There's your C1, your asset, your C2, the price, your C3, the time frame, and then your C4, which is the check, all right? The money on the wood that makes the bet good. There it is, all right? So let's talk about the risk, okay? What is the risk to the seller? Because when you're in the stock market, one of the things that I recognize that people are going to ask, people say this all the time. Well, Jason Brown, why would someone sell me the right to buy their stock? Okay, so people want to understand, even though it doesn't matter why they would sell that to you, only thing that matters is why you would do it. But people want to know, why would someone do that? So I want to break down why someone would do that, whether it's a house or the stock market. And then we're also going to break down why you would even enter into that agreement or into that contract. Okay. So let's take a look at it here. The risk and the benefit. There's always a risk and a benefit for both parties. No one's going to do it and it's just risk for them. No one's going to do the other side of the deal if it's just benefit for them, right? Each party has a risk and a benefit. So let's talk about the homeowner. This is the guy who owns the house or owns the stock as we think about the stock market. The risk to him is he can't sell his house to anyone else. So why is that a risk? Well, what if in the next 30 days, they come to his neighbor and say, we're building a casino here and we're willing to pay $300,000 to every homeowner. He can't take that $300,000 price now because he's like, I'm already in a contract with this guy and I already agreed for the next 30 days to sell to him for $100,000. So that's the risk. The risk that the homeowner runs is that his prices could go up and he can't capitalize on it. The other risk to the homeowner is that the house is a liability. So what do I mean by that? Well, what happens if you're, let's pray for our friends in California right now, but there's wildfires again in California, right? So let's just say this guy's home is in California. I'm just using that as an example. He has to hold the asset for 30 days. Well, now there's wildfires going on day 15, and his house is in jeopardy of getting burned, right? He can't sell it. He can't get out of it because he's in a contract with somebody else. And so you're holding a liability where something could happen to it. A tornado, a storm could come through. Now, if we put this in stock market terms, you're holding a stock, but the risk is that the president could come out and say, we're back at war with China. Then come out with some news and say the coronavirus is worse than we thought, right? So there's all these risks to the person holding it for the next 30 days. Does that make sense? So that's the risk of being a homeowner and entering into that agreement. Now, if you look at the benefit, what is the benefit to the homeowner? Well, maybe the homeowner says, well, we're not near the forest fires, so that's okay. The chances, we're in the middle of summer, the chances of a tornado coming down, unlikely. I haven't heard any talk about casinos coming to our small town. So we're fine. So the homeowner is saying, I get to collect $1,000. And if this guy doesn't buy my house in 30 days, I get to keep the deposit, right? Because that's the risk I'm taking on, that I can't sell it to anyone else and that I have to hold my house for 30 days and something can happen to. I'm still responsible for gas, electricity, lights, all of that stuff. So I need to know that you're serious. And if you're not serious, I still get to keep this $1,000. That's the benefit to me as a homeowner. Same thing with a stock seller. Okay. If I own 1,000 shares of Apple and I enter into this agreement, I'm saying I can't sell my Apple. So if Apple price goes up $50, I can't capitalize on it. That's a risk to me. What if Apple stock falls $50? I can't get out because I agreed to sell it to you. So if I am going to take on that risk, I want to get paid $1,000. So I'm trying to give you the mindset of the stock trader or the homeowner, trying to bring it home and make it simple to you. All right. Now let's go to the other side of the coin and let's talk about the benefit of the buyer. Now, there's two types of buyers. Okay. Home buyer number one, this guy actually wants to live in the house, and we're going to talk about that. Home buyer number two doesn't actually want to live in the house. He just wants to make some money off the opportunity that he sees with the house. And that's what we're going to talk about. Okay. So we already know who the seller of the stock is or the house. Let's talk about the two different type of people who would actually buy this stock or option and enter into this transaction. All right. So in scenario number one, I already told you, this guy actually wants the house. He wants to live there. He's like, I love the house. It's great. It's brick. It got a picket fence. Love it. That's the same thing with the stock market. They're like, I love Apple. Great company. My grandfather worked there, whatever the case may be. Okay. So the risk to this person who wants to own the house or the stock is that they risk possibly losing $1,000, right? And why would they risk losing $1,000? Maybe they get an inspection and they find out that there's termites. They find out that the foundation isn't good. And they're like, I just need to walk away from the house. And let's say they walk away and they forfeit their deposit. Okay. Now, if you're a realtor, right, because I have my real estate license, don't come and say, well, there's legally reasons why you could walk away and still get the deposit back. That's not the point here. Just assuming everything is fine, and for whatever reason your guy changes his mind or finds out that, there's a garbage dump or whatever in the neighborhood and he doesn't like the smell of it. And the seller's like, that's not my problem. Like, I took my house off the market for 30 days for you. You forfeit your deposit. Okay. So same thing with a stock. If something happens where you don't like the company anymore, it's like, well, your $1,000 starts to diminish, right? But what's the benefit if you own the house, if you do buy the house? Well, the benefit is you get to buy the house, you get to live in it, okay? And so you get to raise your family there. Same thing with a stock. What's the benefit? You buy it, you're an owner, you feel proud, you collect dividends if there's any dividends. If the house appreciates in value, you get to participate in that. So that's the other benefit, right? You buy it for $100,000, maybe 6 months, a year later, or maybe you get an appraisal and they say this house is worth 120, and you're like, yes, I hit the jackpot, right? I bought it. I'm in contract with them for 100,000. Well, it's the same thing with stock. Somebody agreed to sell it to you for maybe 100,000, but within that 30 days, maybe the price of the stock goes up and now it's worth 200,000. Now I'm using some big numbers, right? Stocks don't typically jump 100 to 200,000, but I'm just trying to keep it in alignment with the house example. In 30 days, let's say the house goes to 150,000 or the stock. You're like, yes, I own the house or the stock and it's went up in value, right? So that's scenario number one. Now, scenario number two, this guy actually doesn't want to live in the house. This guy just wants to control the house, okay? So big difference. So they both have the risk of losing $1,000, but this guy want to control the house. So what's the benefit to this guy? Well, number one, he doesn't have to come up with $100,000 because he never actually plans on owning the house. He only wants to control it for 30 days. And so he only has to pay $1,000 for that contract or that piece of paper to control it for 30 days. All right. Second benefit is within that 30 days, let's just say he gets an inspection or he already knows this house in this area could go for about 110 in the next 30 days. So he has it under contract. He can go shop that house around and say, hey, I saw you at the open house too. Well, he went in a contract with me. If you really want to live here, this is a booming neighborhood. Things are going up. You can move in for $110,000, right? And so he basically has the contract, the control of that house, that $100,000 asset, but he's controlling it for $1,000. And he can go find somebody else who wants to live there for maybe 110,000, right? Who maybe missed out on the bid or didn't get there on time. Now, how does this relate to the stock market? Let's just say you buy an option to control a stock, a $100,000 stock, okay? And over the next 2 weeks, you got 30 days, but over the next 2 weeks, that stock goes from 100,000 to 115,000, right? Now you can go shop that contract around and say, if you really want to own the stock, I can get it to you for 100,000, but it's worth 115, and you can make money off the middle, right? Off the price. That contract that was $1,000 is now worth at least $15,000 because that house went up in value or that stock went up in value. All right. We'll walk you through a drawn out example. And I think this is where most people get lost with options because it's math, it's numbers, and people don't understand the art of the deal, the art of the transaction. But that's what we're going to break down for you today. All right. So here's what we're going to do. We're going to go to the whiteboard. Yes. Jerome says, so Jerome says wholesaling in home terms. Yes. If you're familiar with real estate, that is called wholesaling. All right. That is called controlling the house that you never actually wanted to buy, and then you wholesale it to somebody else who actually wants to go in, fix it up, or actually live there. That's correct. That's called wholesaling in real estate terms. And so there is a way that you can wholesale in the stock market as well. All right. So let's go to the whiteboard. I want to draw this out for you. And this is the time for you guys to pick a stock for me. So I want you to put in the chat a stock that you want me to look up. And then let's look at what the current price is of the stock. And then we're going to walk through basically a real live example of how this whole thing would work. I'm actually going to log into my Street Smart Central here too, pull up my demo account. So pick a stock and then we will break down how does this work? How do I wholesale a stock like Apple, right? I know a lot of people want to see Apple. Apple's getting ready to do I think it's a 4-for-1 split. So we can look at Apple. We're going to walk through Apple. Deborah says, what about ETFs? You can do this with ETFs as well, but I'm going to stick with Apple because most people understand Apple. And if we have enough time, perhaps we'll do two of them. Maybe we'll do Apple and we'll do Tesla. All right. So let me share my screen here. So let's look. So Apple stock at this moment, let's walk through it. So Apple stock at this moment is going for how much? $504.92. Can we round that up to 505 just so that we can keep it simple? So let's round Apple stock up to 505. And then I want to walk through this sheet we have right here. All right. So Apple stock is going for 505. Next, I want someone to pick the time frame that we want to control it for. All right. So I'm going to write on here, Apple stock is going for 505, right? Stock is going for $505 as of right now. So actually, no, let me erase that. Let's walk through the C's as if you were filling this out on one of our cheat sheets. All right. So first C is the stock. So we already determined that it's Apple stock. So what's Apple's ticker symbol? It's AAPL. Let's just double check. Right. All right. It's AAPL. So ticker symbol is AAPL, which is Apple. So that is the stock or your C1, that asset. Okay. Now, what is the purchase price? Okay. So a lot of people are saying, so we're seeing 2.5 months. Okay. Options don't go on like 2.5 months. Deborah Reed says 2 years. That's too far out. So we're going to go with, I'm going to pull a trump card here. No pun intended. And I'm going to pick 30 days for Apple. Okay. So we're going to pick 30 days. So our time frame, we want to control this for 30 days because 2 years is just too far out. In 30 days, you can at least come back and see these results and see what happened. All right. So if Apple's currently trading at $505, how much are we willing to buy it for in the next 30 days? Okay. Pick any number between, 475 and 525. How much are we willing to buy Apple for in the next 30 days? You guys pick a number for me. We're going to look that number up on the option chain, but you just pick a number. So we got the stock, which is Apple. We don't have the price yet because I'm waiting for you guys to tell me, but we do know that we want 30 days because I picked 30 days, that we want the option to buy it. Okay. We can't get the cost of the option until we get a price. So what is the price that we would be willing to buy Apple for? Now, this part may be foreign to you because you may be saying, well, how do I determine the price? That goes into learning how to read a stock chart, determining where we think Apple can be in the next 30 days. That's a whole nother lesson that we teach in foundations when it comes to stock chart reading and future forecasting the price. All right. But for now, let's see here. So JC says 425. All right, JC, let's look at 425. That's going to be expensive. But let's look at it. Because if Apple's trading at 500 and you want to buy it for 425, let's look. Let's look for a 30-day option. So that's 12 days. Okay, so this is the closest we're gonna get because there is 33 days right here. Okay, and then JC says she wants to buy Apple for 425. Right. Well, here's the thing: if it's trading for 505, well, it's now 503. For you to buy it for 425, someone's going to charge you at least $75 an option. All right. So if you look over here for 425, you're going to pay $84 per option, and the option controls 100 shares. But let's just stick with that example. Okay. So let's stick with that. So let's just stick with that for a second. All right. So we want to buy it for $4.25. All right. And then up here, we'll put current price. Okay. Current price is like 500 and now it's like 503. All right. So if you're looking at this chart and Apple's right here at 503, what you're saying is, I want to buy it for lower than what it is right now. They're going to let you do that, but people aren't stupid. They're going to say, if you want to buy it for $4.25 and it's at 503, why would I give you about 80? What's that? Why would I give you $78 of Apple premium? Like, it's worth, you're trying to get me to give it to you at a $78 discount? No one's that stupid. That's why this option's going to go for at least 78. You see the intrinsic value 78, but you're going to pay $465 for time. So they'll sell that to you for about $82.50. All right. So let's just say you want to do that. You can buy it for $82.50, right? You can buy it for $82.50 a contract. Why is this important though? Because if you look at it, in order to buy, let's say you were going to buy 1,000 shares of Apple. All right. Let's just say you were going to buy 1,000 shares of Apple. Let me do this. Get a new page. Let's go stock versus, and we'll go option. Okay. Let's just say you were going to buy 1,000 shares of the stock. Okay. Well, 1,000 shares times it's going for $503 a share equals, you got to come up with $503,000. Okay. If you wanted to control 1,000 shares, right, you'd buy 10 contracts, because 10 contracts, a contract controls 100 shares, right? So 10 contracts times 100 shares times the cost of that, which we just determined was what? Let's go back. $82.50. And this is where most people are going to get lost, because guess what? It's math, right? Okay. But here's the difference here. Okay. Here you would have to come up with 82,500. If I take 1, 2, the 2 zeros, I'm sorry, 1, 2, 3 zeros and move them over, and we move the decimal 1, 2, 3, right? You're left with 82,500. So what's the big difference? Do most people have $500,000 to own Apple, or do they have 82,000 to own Apple? All right. Now, to me, no one would ever do that. That's just a bad trade or a bad investment. So I just walked through that because that's the number that you gave me. But let's be more realistic. Let's just say you want to control Apple at 505. All right. So let's do another example, because why would you go that far in the money? Let's just say you want to control Apple for $505, right? But it's only trading for 503. Okay. But that's okay. So for the next 30 days, you would like the right to buy Apple at 505. This is where it becomes more realistic. All right. So let's go near the money. And Apple at 505, you're going to pay $28.35 for that. All right. $28.35. Okay. So again, you're going to pay $28.35. $28.35. Now, if we go back to the same example, here, if you still wanted to buy 1,000 shares of Apple at 503 or 505, doesn't matter. You still would need $503,000. But on this side, now you went with a, I want to say, more reasonable option. Now, don't, here's what can be confusing. Someone's going to say, why did you pick that option? This isn't a lesson about why I picked that option. That's why we have a course on it, because it would be there's more to explain on why you would pick it, but I'll give you some insight on why you would pick that option. But it was 28.35. Okay. So now you control Apple for, moved again, the zero is over, boom. Okay. So now you can control Apple for 28,350 if you were to buy 10 contracts, which would control 1,000 shares. You could also buy one contract and control it for 2,803.50. But what I'm trying to get you to see is, do most people have 28,350 or do they have 503,000? 503,000. Or what if they just wanted to control 100 shares of Apple? 100 shares times 503. It's going to cost you 50,000. Whereas over here, if you wanted to control 100, you just need one contract, because one contract controls 100 shares times 28.35. So you got 28.35. Now it costs you $2,835 to control Apple. Little bit more reasonable, right? To come up with $2,000. Now, why would you do that? Why would you do that? All right. Well, if you believe Apple, let's give you a little bit of background on why you would do that. If you believe Apple is going to 550, right? Then if you paid $28 to control it at 505, that means your break even. So Apple needs to be at least at 533. Does that make sense for you to break even? All right. So before I lose somebody, why is 533 your break even? Because you put out $28 for the right to buy Apple at 505, right? So these two coincide with each other. So you basically said, hey, I want to buy Apple. Okay. How much? I'm willing to buy it at 505. Trader said, okay, how long do you want to enter this deal? For 30 days. That trader says, well, then you're going to have to pay me $28.35. You said, okay, I believe Apple's going to 505. So how do I calculate my break even? Okay, I'm going to call this BE. 505 plus the 28.35 is how we come up with 533.35, right? So I just rounded to 533. But you think it's going to 550 in the next 30 days, okay? So if Apple gets to 550, everything above 533, you're making money, all right? Everything above here, you make money. And so you never really wanted to own Apple. You just wanted to control it for 30 days because you believed it was going up, okay? You believe it was going to go up past the price you bought it at, plus the cost you paid for it, thus allowing you to make some money, okay? That is the options game, ladies and gentlemen. All right, now that's just a portion of it. We just did big picture this week, all right? We just did big picture. But I think the key here is there's some things you still have to learn, okay? You have to learn which option to pick, which expiration, how to execute the actual trade. Why would I pick that option, Jason Brown? Right? So you will not be an expert just from this session. However, you just have a bigger picture idea of how it works, why this person would even enter that agreement with you, why you would even enter that agreement with somebody, because you believe it's going past the price you can buy it at and past the cost you paid for it. And you believe that's going to happen in 30 days. Okay. Now we could get into what happens if it don't happen in 30 days and this and that, but that's why this is a 5-part series. There's only so much we can cover. And then even after that, that's why we have a course on this stuff, because there's so much information. So I'm going to take some questions, but before I do, I want to make sure you know about the stock option starter pack. Okay. So whether you're watching it live or the replay, download the stock option starter pack. It's a not huge, but it's a PDF packet that we put together with examples, downloads, all kind of stuff, walking you through how options work, how to think about it, examples, and everything that you're kind of seeing here today, but a little bit more in depth, and you'll have something physical and tangible. And then there's more examples, more case studies, and some other things like that inside that pack. So make sure you download the stock option starter pack. That's one thing that you can do. Also, questions, comments, if you love this information, this is my direct number. I'd love to hear from you, whether it's in the comments or texting me directly saying, dude, that either opened my eyes or I'm still confused. Either way, love to hear from you. You can text me directly. So, but this is big picture, how options work. And that was the game plan today, to give you a big picture, high level overview. So let me take a look at some of the questions coming in, and then we will get ready to wrap this up. Aman says, thank you for that example. No problem. Veronica on Facebook says, so when you buy options, it's always best to be in the money to make it realistic. So not necessarily, Veronica. And that's what we go into in the course. Should you buy in the money, at the money, out the money? Not to mention, you can be a seller of options, which is a whole nother side of the equation. So when is it a good time to be a buyer? And then when is it a good time to be a seller of options? So there's a lot more to this than just, yes, you should always buy in the money, or no, you should never buy in the money. The answer is it depends. Depends on your strategy, depends on the market conditions, depends on the chart of where we think the stock is going. There's so much more to this than to just say a blanket yes or a blanket no. So I hope this was helpful for you guys. And then make sure you tune in next week, where we're going to talk about phase 2. I think we're going to dive into call options. Then week 3, we're going to dive into put options. And then week 4, spreads, which really gets crazy. And then week 5, we're going to talk about the top 10 option questions. I also want to put in, what's the link to the PDF? I'm going to put this back up here one more time. It's stockoptionstarterpack.com. We'll also have the link in the description, so you can go to the description. But again, stockoptionstarterpack.com. And I'll see you guys on the next one. Hey there, Jason Brown here, and thanks for watching my videos. I want to let you know about my premium group coaching program, where my courses, coaching, and community is housed, which is inside of Power Trades University. Many times I get comments like, Jason Brown, I love your teaching. How can I get more of it? How can I work with you? So inside of Power Trades University, I've written courses like Foundations, which teaches you how to read stock charts, how to determine the best time to buy and the best time to sell. I'm also going to walk you through how to do fundamental research and the 3 most important profitable patterns, and a whole lot more. Inside of Options Explained, which is my stock options course, I'm breaking down how to use calls and put options to supercharge your account in good markets and to protect your accounts in bad markets, and potentially even make money from falling stocks. I'm also going to walk you through in my advanced options course how to use advanced strategies like strangles, iron condors, butterflies, all the advanced combinations to put together direction neutral strategies where it's possible to make money regardless if the stock goes up or down. You're also going to get access to me live 2 hours a week, where I actually take what's taught in the courses and I apply it to the real market as I look for real trades with my real account and look to put real money to work looking for stocks and options to trade. You're also going to get access to our trading community of hundreds of other traders just like you, anywhere from beginners to advanced traders inside the community that are putting the information to work, sharing their charts, sharing their trades, getting feedback, learning, and growing their account every single day. So to get more information, just visit powertradesuniversity.com. And if I'm the coach for you and we have the courses for you, then we'd love to see you on the other side. Thanks for watching.